So thanks to the four of you. This year, we've seen cryptocurrency values collapse by $2,000 billion, and markets crash, crypto exchanges implode, file for bankruptcy, investors losing their money, workers losing their jobs. The parallels to past financial crises through our history are troubling. From wildcat money in the mid-1800s to the dot-com bubble burst in the 1990s to the over-counter derivatives that led to the 2007-8 financial crisis. Unlike traditional bank or credit union deposits, which Americans use to get paid, buy necessities, build their savings, private cryptocurrencies are not backed or protected by the government, and they shouldn't be. We've seen them used for speculation and fraud and scams, sanctions evasion, outright theft. There doesn't seem to be anything useful or beneficial that hundreds of speculative cryptocurrencies can be used for. Since I've been chairman of this committee for close to 2 years, many on my side of the aisle have raised warning flags about this. The last thing we need is for risky new financial products to crash our financial system. Thank you, those of you on this panel, for your skepticism about cryptocurrencies, and we will continue that work. As all of you pointed out, digital assets pose risk to our financial system. There are many other risks we need to focus on to ensure banking and credit union system is resilient for consumers and small business owners. So a question for all four of you. What are the biggest risks that your agencies see? How could they harm working families and small businesses on Main Street? What are your agencies doing to protect against them? I'll begin with Mr. Harper, then Mr. Gruenberg, then Mr. Tsu, then Mr. Barr. So if you would answer, each of you take a moment or so and answer those questions.
Certainly. Generally, I see four risks that are coming down the line. First is interest rate risk for the institution itself. Second is liquidity risk. The third is cybersecurity risk, and something that we're watching on the horizon would be credit risk that happens, particularly as unemployment rises. There is a correlation in the numbers that shows that as unemployment rates go up, we often see an increase in charge-offs and defaults. That's something that we're going to be watching very closely moving forward.
Thank you. Mr. Gruenberg.
Thank you, Mr. Chairman. I think first and foremost, as I outlined in my oral statement, I do think we're at an inflection point here in the economy with the Fed having shifted the conduct of monetary policy, and we have a rising interest rate environment. And I do think that presents a number of potential downside risks to the banking system that I outlined earlier. I think our institutions are going to have to pay close attention to the interest rate risk that's accumulated on their balance sheet, both through longer-term assets that they've accumulated, and I mentioned in particular the unrealized losses on securities on their balance sheets. And I also think there are asset exposures that our institutions have, particularly in commercial real estate, which we've had experience with during other times of potential economic and financial stress, as well as in the mortgage market. So I think from a supervisory standpoint, with the changing economic environment as financial regulators and banking regulators, we're going to have to pay close attention in particular to these developing issues.
Thank you, Mr. Tsu.
So I think the greatest risk is the risk of complacency. The risks that are facing the bank industry are fairly well known at this point: interest rate risk, credit risk, operational IT risk, cyber risk. The risk that banks are facing is that they are not paying sufficient attention and vigilance to that as we deal with other more headline risks such as crypto. There are some tail risks that are also out there that we need to pay attention to: global geopolitical in the commodity space, non-bank financials. These are also well known and have been identified by the FSOC and others. So just encourage banks and supervisors to stay on top of those. Thank you.
Thank you. Mr. Barr.
Thank you. Like the others, we're paying careful attention to the way in which supervised institutions are managing liquidity risk and interest rate risk. Cybersecurity is always an issue to be watchful for. We're worried about making sure that financial institutions are thinking about potential risks if the economy softens. So particularly, as others have said, in commercial real estate, residential housing, which are the sectors most often that are leading indicators for risk in that area. We're paying attention to longer-term risks as well. We talked, I think all of us, about the longer-term risks with respect to climate change. Events abroad might cause disruptions in the United States. So the war in Ukraine, Russia's war in Ukraine, obviously is devastating for the people of Ukraine and also creates enormous potential risks in Europe and elsewhere. And we're paying careful attention to risks in China as well, with slowing growth there and a political turn inward that may cause additional risks to happen. And lastly, we're concerned about the risks that we don't know about in the non-bank sector. That includes, obviously, crypto activity, but more broadly, risks in the parts of the financial system where we don't have good visibility, we don't have good transparency, we don't have good data. That can create risks that blow back to the financial system that we do regulate. And so we pay careful attention to understanding those risks as best we can.
Thank you, Senator.